Well, good morning, everyone, and want to thank you all for taking the time to join us this morning here at FCF Advisors for our first quarter update. My name is Cate Daly, and I'm the Director of Sales here at our firm, and I'm joined this morning by our CIO, Bob Shea. We all know it's been quite an eventful quarter from a macro perspective, so we certainly do plan to keep this update short and sweet. As a reminder, though, if you do have a question, please feel free to submit one via the Q&A tab, which you'll find at the bottom of your screen. Now, for a brief outline here on what we plan to discuss today, obviously inflation, it's a hot topic as, it continues to soar with consumer prices up year over year to their highest level in over 40 years. So that said, we'll talk about the Fed's response to it and the resulting headwinds that many allocators are facing today. And to close it out, we'll provide an update on our investment solutions that are all built from our free cash flow quality model. So with that, Bob, to kick it off here, let's talk inflation and the Fed's response thus far.
Terrific. Thank you, Cate, and thank you all for joining us today. We realize a busy week, a busy time, and no shortage of things to navigate, hurdles to navigate. And with that, we started out with the good, the bad, and the ugly as a title, and I know that's kind of edgy, but I think it's actually an understatement. Just from a good standpoint, I wanted to just this morning we got the American Association of Individual Investor Sentiment reading out. It has been really chronically low, but today was a wow. And showing sentiment at bearish levels and spread between bulls and bears, literally like of 2008-9 bottom. So as difficult as the environment may seem, as behind the curve as the Fed may be, folks have definitely taken notice, and bearishness positioning has really gotten to readings that typically coincide with pretty significant bottoms, which I don't think you're hearing a lot about there. With regard to inflation, I think, listen, we're trying to keep this simple, right? This is varsity level macro that we're seeing. I kind of think of this as cycle compression is really the issue we're dealing with. If you remember, coming into 2020, we were in a mid to late cycle environment where the mega cap tech names were driving the index level. We had really, it felt like we were kind of really having what looked like a melt up in those names driven by very low interest rates. Then we had the COVID crash. We went into an immediate recession from that, and then an equally powerful recovery response that started with the Fed, and then was met with fiscal around the world that we've not seen, and printing money, monetary MMT, money printing, writing checks and sending those out. Which brings us to a very inflationary environment toward the end of last year and into this in which to navigate. We are getting that to accelerate that. We had the war in Ukraine, really accelerating and exacerbating inflation. Wars are inflationary, and this is no exception, particularly with the oil, the energy, the grains coming from that part of the country. And just how quickly things change and narratives change. It was just a couple of weeks ago that we were talking about, just an inflationary bust. And now we're with China really locking down Shanghai, really with the zero COVID policy. We're really starting to get growth scares. So there's no shortage of things for folks to worry about. Inflation is persistent and high, and we see that as unfortunately going to be with us for a while. Not at the 8% levels that we're seeing now, but even more moderating, but well above where the Fed is. And what we're seeing is, so we have inflation. We know all the reasons for inflation. We now have the Federal Reserve's response to inflation being, as we know, very behind the curve. And what really makes markets volatile is not so much raising interest rates, it's the view of a policy mistake. And in this case, the Fed inviting inflation and then really being slow. I mean, we're still, let's think about this, folks. We are at 25 basis points right now. And the VIX is at 35. We have, we're anticipating some pretty dramatic moves in interest rates. But I would focus not so much on the end of the year or next year, because the Fed's forecasting hasn't been stellar going back, historically. I think what we can count on is 175 basis points for July. So that seems like, even with this, GDP report that, forward-looking GDP print today that was negative, we can count on, because of this 8% headline inflation, we can expect the Fed to, between May and July, something like 175 basis points. Again, the Fed controls the front end, markets control the back end. So that's really important to note. And again, before we dive into some of the ways to navigate this difficult environment, just some of the headwinds that you as allocators are facing as we in 2022. We have an energy shock turned crisis. Again, energy markets were tight before the Ukraine war. Now it has become an outright energy crisis, particularly in Europe, where natural gas, coal, and oil prices have soared. Deglobalization, I don't think I hear enough of that out there, but the powers of deglobalization were in place for much of the last 4 years. Like, this wave of globalization spurred really low interest rates, cheap labor, and manufacturing, really keeping interest rates low with a real growthy vibe to low interest rates, the ability to use long duration treasuries as a hedge. Deglobalization, we can go back 5 years to Brexit, to Trump and some China trade wars, tech wars, and this genie as well, not going back in the bottle, is everyone exacerbated and accelerated by the Ukraine war. Folks are going to be taking their supply chains onshore, which are going to bring capex and inflationary and margin pressures, no question, as folks, not just energy, but things like semiconductors, are going to be very national, very strategic from national standpoint. So that's a powerful force that was keeping the lid on interest rates for much of the last 30, 40 years, that has changed for the good, is what it looks like. Central banks, as we know, and we've heard a million times, they have less room to maneuver. Again, I think I'm a little more optimistic than most. I don't think the Fed's going to be able to execute what they said they're going to have to do. I think it's safe to say that there'll be 175 basis points between now and July. I think things get trickier from there. But what you really do have is this massive, and what you're seeing this morning, there's a massive divergence in policy between what Japan is doing and what's going on with the Japanese yen, where Japan is easing conditions. They have lower inflation. That's a function of their demographics and a lot of their own dynamics. But they're doing yield curve control. They are pegging 10-year rates at 25 basis points and basically setting fire to the yen to keep it there. That will actually have some deflationary forces coming out as cheaper Japanese goods will be coming around the world from that. But again, this is massive divergence causing the dollar to rise. And Europe, obviously, the euro has been plunging along with the yen, but for different reasons, more for being a lot closer to dependence on to Russian oil and gas. So central bank policies, less room to maneuver, but really divergence in policy. And then looking a little bit forward, toward the midterm elections, and we know about monetary policy has changed. Perhaps fiscal policy gets tighter if, in fact, the GOP changes, the House changes, and the GOP has a little more control. So we're really trying to keep this simple. Inflation is high. Central banks have less room to maneuver. There's a lot of fears out there about recession, but what it really feels like is cycle compression. And what can make this change pretty in a hurry? China reopening and helping supply chains would definitely, and reopening the global economy would help. That doesn't look like it's anytime soon in the short term. However, on the longer term, it does. And any breakthrough or peace in the Russia-Ukraine war would also help. Just very quickly going through, reminding you, we're going to focus on some solutions for this very difficult environment. And free cash flow is really, as you know, what we focus on. And what we have done is really simplify what we're doing. Everything we do is focused and comes through the lens of free cash flow analysis. Nobody analyzes companies like we do. This FCFQM, or the free cash flow quality model, informs, powers all of our strategies from our index side of our company, our institutional SMAs, as well as our suite of ETFs, both core and thematic. And very simply, we focus on free cash flow quality. I would urge you all, if on your own time, to take a look at a really wonderful piece that my colleague and fellow PM Vince Chen wrote about a better approach to quality factor exposure. But this free cash flow profitability factor, we've done 20 years of research. It is and it has shown the highest correlation to 1 month forward returns versus all of the other traditional measures of quality, like ROE, ROA, gross margin, as well as traditional factors like value, growth, size, etc. This model looks to screen companies for strong and sustainable profitability. So many companies that focus on earnings and prior earnings really miss the predictive aspect that we get from looking at quality of earnings or accruals information. Again, we have a white paper on our website really taking a much deeper dive into our investment process, but very simply, we screen for companies and build portfolios of companies with strong and sustainable profitability. Again, we prefer to focus on free cash flow. Earnings can be unreliable, backward-looking, obviously can open to manipulation and discretion, whereas free cash flow can be more reliable, forward-looking, and the goal of all active managers is to maximize information ratio. It's, we made some adjustments to our investment process in Jan 2021, and boy, they have paid off. We've really focused on an active quantitative approach to getting our free cash flow intellectual property directly into our products, and it has really yielded some terrific results. For our flagship US Quality, we have had alpha over the S&P 500 for this period of time, the last 16, 17 months. And we are really have some tremendous outperformance versus the quality, the quality peers in the group, where we're focusing on, we're really redefining the quality factor investing. And again, I'd urge you to take a look at this paper that Vince wrote on a better approach to quality factor investing. Our 5-star international quality ETF, TTI, is having a tough year, but it's more of a mean reversion from several years of outperformance, and we do expect that. I think that has been hurt with what's going on in Europe and some of our model as we really collect the data quarterly. And I'm sure the free cash flow profitability scores that are coming through this quarter will really play out and hopefully get some mean reversion in the international fund. So what we're talking about is we have core strategies where we focus on free cash flow, where you can get some alpha over the broad index, keep you away from concentration risk, particularly now as we're dealing with the indexes with some 25, 26% of exposure to these mega cap techs that are really having a rough earnings season and a rough couple of earnings seasons. As you can see, we have been anywhere from 12 to 1,400 basis points underweight these. And a lot of folks and a lot of talk. I read a Morgan Stanley note last night where they're really advising folks to rotate from some of the passive, very mega cap passive strategies into more active strategies. This is a model that does the driven approach. That is underweighting these exposures from our own screening lens. With that, I'm going to turn it over to Cate. So we have our core strategies, which we talked about. We also have some thematic exposures that we've built for another asset manager. We have built a real asset exposure, and we've built a profitable innovation or a product that really focuses on pairing free cash flow profitability and R&D intensity. It's well documented the trouble that some of these unprofitable tech names have had. But I think that we have, and we were just down, Cate and I were just down at the Exchange ETF conference, which has really turned into a asset management conference, as everyone is in ETFs these days, just a wrapper, a more efficient wrapper for strategies. And two of the biggest themes of the three themes down there were inflation and innovation. With that, I'm going to turn it over to Cate, who comes to us at Free Cash Flow FCF Advisors from Brookfield. She's got some terrific real asset background. I'm going to have her walk you through that exposure.
Thanks, Bob. So today, we know many investors, they're looking to increase their allocation to alternatives. So one of the strategies I would like to highlight in lieu of the current environment is the real asset ETF, and it invests in the equity securities of companies that are owning and operating real assets. So owning and operating assets such as REITs, real estate investment trusts, infrastructure. So think cell phone towers, utilities, toll roads, master limited partnerships, MLPs, and natural resources. And here on slide 10, I really like this diagram, which illustrates how real asset securities impact our everyday lives. End user demand for these essential goods and services provided by real assets, it tends to be relatively sustainable and inelastic throughout a cycle. If you think about it, we are all always seeking roofs over our head, water to brush our teeth, electricity to turn the lights on. We want those Amazon packages at our doors next day. So Bob, if you want to flip to the next slide, while these, asset classes, they each are very different. They have different fundamental drivers and business models per se. There are several features which bind them together. And, potential benefits of real assets include, within an asset allocation, include diversification, potential hedge against inflation, attractive total returns, and, greater income yield potential. And to expand on that, just a bit, all these real assets, they're backed by tangible hard assets that tend to generate returns that are linked to inflation, as their cash flows tend to be tied to contractual inflation escalators, which can lead to capital appreciation. And in addition, the revenues of these companies, they're visible, they're recurring, and they're frequently based on long-term contracts or government regulation, which can provide greater income potential versus broader equity and bond yields. So Bob, I think it could be helpful. I'll pass it back to you to briefly discuss how our free cash flow quality model is applied in the ETF, along with the more thematic idea.
Yeah, again, so we built these two thematic exposures from our intellectual property for Donoghue Forlines. This DFRA is obviously hitting on the hottest topic in the markets right now, or addressing inflation. And again, it's built like everything else from our index intellectual property. We really pair free cash flow profitability and and strong quality of earnings. In this case, with these five core real asset equity buckets, also taking high dividends as so the folks, the companies in those groups with high dividends to really enhance the yield. And that comes up with a free cash flow quality dividend score. This product is just 6 months old. It is, top of its category, doing a great job. And one of the nice things about having this architecture that we're building our strategies from, really everything we do comes from the same spot. So if folks are comfortable with what we're doing in our flagship ETFs, it can easily be extrapolated to these thematic ETFs. I think it's terrific exposure for this environment. And as we were saying, I want to also talk briefly about the innovation. And again, innovation was a big topic. We all know what's not working. What's not working are companies that are not profitable, that are, obviously their growth was being discounted by very low discount rate with interest rates and inflation rising. They've come under attack. We built a product that's been in the market for a year and a half now that pairs. We did it again for Donoghue Forlines, ticker DFNV. And we have paired our free cash flow profitability with the thematic R&D intensity. So to find innovative companies that can fund that innovation from free cash flow, I think it's a terrific theme. And what we're really, what we're talking about here is in a very difficult environment with real cycle compression. I can't remember a time in my career where we have gone from late cycle to recession to recovery to mid to late to already recession talk as quickly as we have. I don't, my guess is it probably isn't as dire as the narrative currently is, and we'll see that unfold. But I do know this. The big, and when we talk about the good, the bad, and the ugly, the clear ugly, what folks are not used to is having their fixed income exposure, whether it's corporate or whether it's treasury, not providing diversification to their portfolios. We're here talking about at the equity bucket and places to be in the equity market where you're not making a huge bet. So interest rates, we all know the longer term trend appears to have gone from lower to higher, but we've also massively oversold, and there is can easily be rotation into growth as well as the inflation theme working. So you have quality equity exposure, but not just quality. What we're trying to prove is that free cash flow, focusing on free cash flow, is a better way to get quality equity exposure. And then we have two great themes that are really on top of mind, which is innovation, but profitable innovation, and then real asset with a yield. So folks have obviously been looking for yield in their equity portfolios. And I think we have some really great solutions for a very difficult environment. I've talked a fair bit. As you know, we recently rebranded. We were Trim Tabs. We rebranded around this free cash flow focus. Everything we do and everything we will be doing is focused on free cash flow. I've taken a fair bit of your time. Obviously, there's no shortage of things to talk about in the market. Our team, we all thank you, and on behalf, I mentioned Vince Chen, Darren Cohen, our Chief Operating Officer, Cate Daly, the FCF Advisors team. Just briefly going through, we talked about performance. This is our flagship TTAC, and we really are excited about how this has been really delivering what we hoped for from the moving to getting our free cash flow intellectual property directly into the ETFs. We mentioned TTAI, rough quarter, but has been a real stellar long-term performer and a 5-star. And putting these together really gives you global free cash flow quality exposure, our two flagships. Cate, were there any questions out there?
Thanks, Bob. It looks like we do have one question here that was submitted, and it's asking, aside from the model, how do you factor in headline risk?
Yeah, so again, we can't, and we're not. They're listen, really, when I say we can't, of course we can if there was a headline that Vince and I needed to adjust, but for the most part, this is like the most important period for us. We are collecting quarterly free cash flow as companies are reporting their earnings. Throughout the last 3 weeks and into the next 3 weeks, very important time for us as we take that and make any changes necessary, either confirming prior quarters or something degrades. So important time for us. Obviously, there's an active component to this that if something warranted a headline, but we'd kind of just we go where the free cash flow takes us, and we're very true to that. So we're going to go where the free cash flow goes. For instance, a lot of folks, were scared to death of Facebook's earnings, but sure, their free cash flow has actually started improving over the last 2 quarters. We put out an interesting note about not owning Netflix, but purely because it just has not screened well for us. Free cash flow has not kept up with net income. And we've Vince and I've spoken on CNBC and some other places that the mega cap names just haven't screened well, not so much from that they're not blowing their numbers out, but from a quality of earnings or the quality of earnings has been lacking and has kept us underweight. We found free cash flow in the tech sector, just in other names. So headlines, we're really true to our process, Cate. There's not a lot of headlines that we're gonna go where the free cash flow takes us, and very, very methodically.
Excellent. Well, thank you, Bob. And folks, it looks like there are no further questions at this time. So again, want to thank you all for joining us today. We certainly appreciate all of your interest and support. Do feel free to reach out if you have any questions down the line. But, on behalf of FCF Advisors, thanks again, and we look forward to speaking with you all soon.
Thank you, everybody. Thank you for joining us.